Markets continue to be under pressure amid uncertainty on tariffs and trade. But how should investors be thinking about all of this volatility? Joining us now to discuss, Jeff Evans, VP, Director and Lead of Empirical Research and PM Support with TD Asset Management. Jeff, great to have you back on the program.
It's great to be here as always. Thanks for having me on.
As evidenced in the trade from day to day, we got plenty of volatility out there. We got plenty of headlines coming at us in every direction. How's this been playing out in the different asset classes, and what should we think about it all?
Exactly. Headlines, tweets, everything else as well, too. But it feels like this isn't just this year. I was thinking about it this morning. This has been 15 years of macro volatility. You go back to the GFC, the European debt crisis in 2012, the U.S. seeing its debt downgrade, the Chinese growth concerns in 2016. This has been a rolling wave just every couple of years.
All the greatest hits.
Exactly. and it just seems like we're back into one of these cycles again in 2025. I guess what's helpful, though, is that does give us a bit of a playbook. We can look back at some of these past cycles, and we can touch on it in a minute, but what we're seeing so far this year is very similar to what we've seen in some of those past macro shocks. Obviously, some of what is going on right now, it just owes itself to what's going on south of the border with the new administration. This is a group that's very sophisticated at managing the news flow, so it probably even packs a bigger punch than other administrations would have had. But it's not really that atypical of a new election cycle. When you get into a new administration or a change, the first year is always a very busy year. New legislation, everybody's trying to get their policies in and do it pretty quickly in the U.S. because you then have the midterms within the second year. So it's not unusual to see a lot of activity. What's maybe a little unusual is just the speed of it. It's been very front-end loaded in the first 2 months. That's created maybe more uncertainty than you typically have. And it's a little unconventional because it's through executive orders, not legislation. We're also seeing court challenges. So there's a few other layers that have made this a little bit more unique, added a little more uncertainty than past cycles. But it's also not just U.S. This is global. We're seeing uncertainty in Canada. We haven't had a prime minister effectively for 2 months. We'll get a little bit of an update this weekend on the new Liberal leadership, but it could be October before we have some certainty in Canada on where the policies are going to evolve. It's happening in the UK, big change in government there back in the summer. And they went from a Labour Party from basically record high in the polls to record low in 6 months. So a significant change, and voters don't even necessarily know what they want. You're seeing that in France, huge amounts of uncertainty in the budget. And then most recently Germany as well, with the new government coming in and very quickly effectively trying to step away from the debt brake. That's been a very significant anchor to their policy over the last couple of decades, talking about scrapping that or changing it significantly and adding a lot of defense spending. So there's uncertainty everywhere. And what tends to happen when you get these environments, and again, go back and look at what's happened over the last 15 years.
I was going to say, how does this playbook help us understand what we're going through right now?
Exactly. So first thing is people retrench, right? If you don't know what's going on, you're going to go somewhere safe. What we do with our empirical research models, we can go through thousands of securities globally, get a sense of kind of what's working, what's not. We aggregate that up. We try to look for broader trends across the market. The one thing that's really standing out is investors are craving liquidity right now, focused on the most liquid investments and typically the largest stocks. So that's been a very clear trend over the last couple of months. There was a little speculation back in the summer when interest rates started coming down. People thought that'd be great for small caps. When Trump started polling well, they thought that would be good for just domestic economy, economic strength, get rid of some of the regulation. That probably comes in time. Small caps at some point will work, but what we're seeing today is that uncertainty is really prevailing, and it's the large liquid stocks that are leading in a lot of our models. What we're also seeing is a clear rotation into the more defensive parts of the market. These are your low beta, low volatility stocks, anything that's more bond-like. So that would be utilities and infrastructure, be certain pockets of real estate, consumer staples. We've seen this playbook play out. It's generally what's happened in all these previous cycles over the last 10 to 15 years. We're kind of seeing the same thing. It basically started from January 20th, this rotation with all the uncertainty into pockets of relative safety in the equity markets. And then the last thing I'd say, there has been some talk of a momentum unwind over the last few weeks. These would be some of the really big high-flying stocks like Constellation Energy and Vistra, where the share prices just took off at huge returns. What we're seeing is that as long as there's earnings growth, a lot of these companies are still holding in. It's where the earnings growth hasn't necessarily come through and materialized. That's where you're seeing a bit more of a sell-off. So I'd say there's a little bit of a momentum unwind in the market, but it's much more really a rotation into safety, liquidity, and to a certain extent, yield as well has been what we've been seeing across the market.
Okay, with these market moves and what you're seeing there, how does this start to play into some of the stocks in your coverage universe? Let's start with the real estate space.
Sounds good. And actually, maybe almost maybe even be better to start with infrastructure.
Go with infrastructure first. We'll flip it. All right, let's do infrastructure.
Maybe we'll flip it around because I think that's where there's a really compelling case right now. Just given the uncertainty within infrastructure, even just going to utilities and pull that out. That's one of the key segments within infrastructure. These are companies that are perfectly suited for this time. If you look at their business model, they own very long duration assets. These transmission lines and power generation are 40-year assets plus. They're highly regulated. 95 to 100% of the business is controlled by or managed by governments. So they set the returns. There is always some degree of uncertainty in what you can earn, but with a fairly good level of confidence, you can project a utilities income 10, 15, 20 years in the future. You're not going to get it perfect, but you can at least have a good sense of what they'll earn. I don't know if you can say the same thing about a stock like Nvidia today. If somebody asked me how many chips are they going to sell 15 years from now, I have absolutely no idea. It could be zero. If you go back to some of the high-flying tech stocks in the dot-com bubble, the Nortels and the BlackBerries, you can be sitting on top at 1 minute and 10 years later completely gone. There's so much innovation, so much money, so much competition in that space. It's really hard to form a clear view of where those stocks could go over the next 10 or 15 years. In the utility case, it's almost contracted and very high predictability. You see that as well in volatility of utilities. They're usually 30% less volatile than broader equities. And where I think they're really compelling today, most of these names have a 3 to 4% dividend yield. Most companies in North America are guiding for 6 to 8% earnings growth, not just over the next 1 or 2 years, but the next 5 to 10 years. There's a lot of visibility given what's happening in power grids and power demand that they're very confident in being able to grow 6 to 8% per year for potentially a decade or more. Put those two things together, 4% yield, 6% earnings growth, you're at 10%, which is what the S&P has done over the long term with a third less volatility. So there's, in my view, the uncertainty should be driving investors into more defensive names, but there's a great opportunity to buy stocks that can deliver the same return or better than the broader S&P 500 at less risk. That should be pretty compelling.
Is the risk in the utility space that if we do end up back in a risk-on environment, say everything we're worried about, it just disappears and stocks take off again, you're not along for that ride being defensive?
Exactly, and there's always rotations in the market if we do see that sentiment shift, and we have seen that whenever you go into risk-on, utilities tend to lag behind. That said, if you look at 2024, not for the first 2 months of the year, but as soon as Nvidia kind of settled down in March, utilities in the S&P delivered the same rate of return. So it is possible, and the critical piece is the earnings growth. What we've seen in the U.S. is a lot of multiple expansion over the last 10 to 12 years. That's perhaps where there's more risk. It's the utilities can deliver on the earnings growth. You're probably not going to see the multiple re-rate. And so that's really the key question: is could the multiples go even further on the S&P to 25 or 30 times? I think that would be the big question in that risk. But it's certainly something to keep in mind.
Got about a minute, but I want to ask you about the real estate space as well. Sounds
great. A little bit more a challenge there because there's a few things going on. Interest rates coming down across the world is going to help real estate. That'll help support asset values. They don't have as much interest expense, so that'll help their cash flows. On the other hand, if rates come down too much because the economy starts to weaken, if we get recession, that's usually not good. People start to give up you go back and live with mom and dad, give up your apartment, those sorts of things start to happen. So we don't want it to go too far, and we'll see where it is. What's really interesting right now in real estate is that with all of the interest rate increases and construction cost increases in the last few years, nobody's building. So the supply demand in 26 and 27 looks incredibly favorable across a lot of different real estate. We just need to get through 2025, get some confidence that we kind of know roughly where things will bottom out, and then things turn very landlord friendly over the next couple of years.